All right, folks. Hello, and welcome to February's market update. My name's Cameron, and some of you have been getting some emails from me here. So wanted to just reach out here and give everybody an update on what's happening kind of in the general market, but then also what's going on here locally here in Phoenix, Arizona. So, which for those of you who are not here right now, it is 69 degrees. It's supposed to be a wonderful weekend in the 70s. So, and it gets down in the 40s at night. So it's quite nice here. So, okay, well, here we go. So one of the things that I wanted to do was start by going back and looking at the interest rates from last year. So this has never happened before where the 30-year fixed rate doubled in a year's time frame. You can see right at the beginning of January last year, January 2022, we were at 3.22%. And it just had a very steady increase all the way through to the end of last year, December 29th, where we were at 6.42. It is almost exactly double year from the beginning to the end of the year. And that's significant because that is a substantial reason why the market started to cool. I think everybody obviously knows all this, but I want to dive a little bit deeper into this. There is a correlation and an existing relationship between the 30-year fixed mortgage rate and the 10-year treasury yield. Okay. Now, full disclosure, I am a real estate broker. I am not an economist. So this is a very kind of lay person's description of what is happening. But if you go all the way back to the 70s, you can see very distinctly that they follow a very, very similar pattern. And more specifically, the spread between the two is, again, on average over the last nearly 50 years is 1.7. So if you kind of translate that into kind of more recent and then today's terms, what you can see on the left there in the first 21 years of the century, 2000 to 2021, we had the 10-year treasury yield rate at 3.49, and there was a 1.79 spread, which is very similar to what it had been historically for a mortgage rate of 5.28. That's the average mortgage rate that we had for those 21 years starting in the year 2000. Today, you can see that the 10-year treasury yield is up, but so is the spread. And that right there is inflation control. That's everybody knows the Fed. They did another rate increase last week. Who knows what's going to happen going forward? It sounds like they're going to keep that pressure on interest rates until they start to see inflation get more under control. It sounds from the reporting that we are seeing some better numbers, but it's still too high for where the Fed wants it to be. So that inflation piece right there, the 2.79, is a larger spread than average. If you applied the historic average going back to that 1972 clip at the 1.79, you would see a 5.48% interest rate, which again, over the last 20 years, excluding the last couple of years, is a very, very average and normal rate. So what does all this mean? Well, if we look at this is now the spread, okay? So we were looking at these 10-year treasury yields, we were looking at 30-year interest mortgage rates, and that spread between them. And if you track the spread, which is what this graph is looking at, and you can see that 50-year average right in that 1.79, 1.8 range, you can see that from, this is going back into 2022, excuse me, you can see we started the year last year well below the average, and it has slowly, hit the average sometime this time last year, a year ago, and it had a steady incline until November, December timeframe, and it started to come down. And what this is really kind of representative of is what we might call panic, right? Panic in the market, panic with the Fed, panic with rates, panic with buyers. Everybody, the markets started to panic. And this, you can see now, I think we're starting to see the pattern, and we can almost say this, more definitively, is that the panic is starting to subside. We saw that slow and steady increase through kind of late summer. And if you recall, that's about the time when the market really did a 180. It was going really kind of crazy bananas in, latter part of 2020. all of 2021 and beginning part of 2022. And we then came into a period here where the market just kind of completely cooled off. And so as the Fed's trying to, fight this inflation, rates are going high, the yield's going high, and then we start to see this, drop. Now there's still a 1% difference from where we are today to historic averages at the 1.8. So we do still have more to come down. And if you follow the trends in the data, this is a really good sign for buyers. And as Lawrence Yun, he's the chief economist for the National Association of Realtors. This is a recent quote from him. The upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. That's a very, very substantial statement. We haven't heard much from him or other chief economists in the real estate industry with that much confidence in their, assertion that it's a good market for you to be buying a home. David Stearns, he was the former Secretary of Housing. This is a quote from him recently as well. So be advised, this may be the one and only window for the next few years to get into a buyer's market. And remember, as the Federal Reserve data shows, home prices only go up and always recover from recessions, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. And it's true. In one of my other videos that I did at the end of December, in December timeframe, we talked about this historic data where the interest rates always go down in a recession. So that's really the kind of the X factor. That's the wild card right now is, will we be, in a recession, formally or informally, however you want to look at this, because it's very vague and kind of confusing and frustrating for a lot of folks. But if we do end up in a recession this year, you can almost be assured that interest rates will go down and prices will go up eventually after that recession. And what is really kind of at play here is pricing. And so the economy, if you just look at it as a whole, is having some struggles on the jobs market, meaning that a lot of companies are doing substantial layoffs. The wage has not kept up with the inflation. So workers are just being paid less based on where the economy of market pricing and goods and everything that they purchase for themselves, including homes, but cars and appliances and services, all of that has gone up, but the wages haven't gone up. So there's a gap there still. And employment rate still remains fairly high right now, but there are a lot of economists saying that will start to creep down as these layoffs start to really take effect. But it's kind of unfortunate because as these companies do these layoffs, their stock prices are going up. And so we're seeing a little bit of a run in the stock market too. But locally here in Phoenix, as we look at, home pricing, nationally here real quick. So this is the forecast for 2023 by several leading industry standards, Freddie Mac, Fannie Mae, Realtor.com, and others, NAR. And if you average all of these out, Realtor.com and Zelman are kind of the two extremes on both ends. But if you really average everything out, it is looking to be a very average year for price appreciation. And we're seeing that in the markets. If you go back and look between, the kind of the years leading up to COVID, and then the years after COVID, you can see that the appreciation in homes was pretty healthy for those, 2.5 years from September of 2017 through March of 2020, and then subsequently, the pandemic, the post-pandemic years, or really pandemic years. Those next 2.5 years, a 38% in appreciation. So, homes, this is also looking at percentage of homes with prices that have been reduced. So year over year comparison, looking all the way back to January of 2021, we were seeing negative amount of homes. And what that means is that home prices were actually going up. That balance somewhat flipped in the spring of 2022. And then we saw, a fairly steady increase. But I think the messaging here is that it is about to start to cool off. We are seeing less price reductions. In fact, just personal experience, we're seeing more competitive offer situations where we've had clients lose offers because they weren't aggressive enough or they were too slow to decide to make a purchase decision, and the home that they were interested in and wanted was just not available. And so the main thing that's driving all of this is inventory. If you look at basic supply and demand, you've got on the one hand, fairly moderate to maybe even slightly below moderate demand right now. But we've got this very, very, very low supply. And it has been that way. And I don't have a graph for this, but this is locally here in Phoenix. In the summer, the kind of that late summer period of 2022 last year, we hit the quote unquote bottom of our inventory at just under 8,000 available homes for sale on the market, which has never been that low in recent years anyways, 30, 40 plus years. Where we should be, if you're looking at a balanced market, we're the 5th largest metro city in the entire country. We should be over 30,000, just above 30,000 available homes. So we bottomed out at, let's say, 8,000. In the subsequent, months after things kind of shifted in the market toward the end of last year, 2022, we saw that balloon back up to over 20,000. It was about 21, 22,000, kind of flirted that way toward the end of last year. And now, as I look at it this morning, it has been for the last several weeks, we're back down to 16,000. So we went way down. We kind of got back up, but we've kind of come back down again. And when there's just not as much homes available, it doesn't matter realistically. We don't need this high demand situation, because that was the COVID timeframe. That was COVID is what perpetrated a lot of this crazy frenzy in the market. And so, this is looking at a few different indices, if you will, or sources, Case-Shiller, CoreLogic, some very reputable companies, about where they think, the home prices, this is in arrears, right? And we don't have any tracking data from November on. That will come out here shortly, I believe, actually at the end of this month, from a lot of these folks. But we can see what prices did in beginning portion for 6 months of the year, and then those last 4 months of reporting, and it's really starting to taper. You can see Case-Shiller kind of peaked in August at a negative 1.1, and now they're at 0.5. FHFA was at negative 0.6. 0.7, excuse me, negative 0.7 in August, and now they're back at 0. And same goes for some of these other indices. So we can start to see that trend. And you can actually track this. This is actually a really great resource, Redfin, their data center. If you just go on Google and type in Redfin data center, you can get access to all of this information. And it'll show you exactly your market based on, you can do counties or city search. And this is just showing the last, couple years of median sale prices. So these are homes that have actually sold and closed in the Phoenix market. The orange line being 2021, which was just a crazy year. We went from just under 340 to just under 440, so $100,000 in that time frame. Last year is the black line, and it kept going. It kind of topped out at 485, or certainly above 480. And that, sorry, I cut off the graphic there, but this is over a 12-month January through December scale. So right mid-year, you can see where that decline started to happen. And what's interesting is you can see another sharp decline toward the end of the year, and then it starts to flatten out in the November, December timeframe. And we've actually seen, if you go to the left side of this, the blue, which is 2023, we're starting to see it slowly tick up, which very much aligns with what all the industry experts, the chief economists, the indices, all of the right sources are telling us. And you can look at this. This is just a Phoenix overview, but you can look at this for virtually any major city across the valley. And this is showing the last 4 years of pricing, pending listings. And we're starting to see this uptick, which is really, really healthy because the purple is 2023, and we need that to get back up. We need that to get back up in that 1200 range. You know, this is weekly, a measurement of residential resale market on the market weekly. And so as we start to see this inventory kind of come back up, I think that's what's balancing out some of the pricing, not getting too crazy out of control. But what it all means is that there's going to be, hopefully coming in the near future, more choice for homeowners, but potentially at higher prices. If the inventory gets up enough and the demand stays somewhat normal, then we won't see this crazy run in the market. But all of this is very much subject to, you know, the specific neighborhood, the specific style of home, the specific price point that you're looking at. And that's why here at Munro & Co. Real Estate, you know, we're able to help and navigate you through all of this stuff. So got my email, got my phone number on here. We are also, we just launched our YouTube channel. So if you look for Discover AZ Lifestyles on YouTube, you're going to find some videos. We've got some community videos in there. This is where we're going to be putting all of our monthly updates and so much other content and video for you to just browse at your own leisure. So go in, subscribe, share with your friends, have them subscribe as well. And anytime you need more information, just feel free to reach out and let us know. All right. Well, folks, thanks for joining us today. And we appreciate the attention and look forward to chatting with you in the future. Take care.